Hi, this is Chuck Oliver. Welcome to this week's Hidden Wealth Solution Review. Well, I want to talk to you about legislative retirement tax risk. This is coming from a white paper from a very kind of connected to Washington and Washington's maneuvers around our tax code. And I'll be bringing you this information as quickly as I can find it because the timing and the shifting of what we do about our assets for income and legacy are in jeopardy, folks. In fact, if you want to know the tax risk road you're on, we've had a number of people take advantage of this, and several of you we've already talked to. Go to retirementtaxcalculator.com. Retirementtaxcalculator.com. Why is this so important, Chuck? Folks, I think of Keith and Betsy, who we met with this past week, getting a head start in being tax smart. So they're leading up to being retired here in a couple years. And they have done very well, right? These programs are designed for people that can benefit the most, that are the ones that have been the makers, right? Saving and contributing to commerce, right? Higher income earners and or stronger savers or both. And they'd saved about just around $780,000 in their combined 401ks and IRAs. And this tax calculator, based on pretty conservative growth rates, because the higher the growth rate, the worse the tax. The lower the growth rate, the lower the tax. So we used a very conservative 5% growth rate, and they defaulted and said, Chuck, I think we're going to still be in this 25% tax rate, but I don't know how long because I think taxes are going to have to go up. Well, folks, I'm in their camp. I think, unfortunately, tax rates have only one direction to go up, and you'll see why in a moment. Well, their projection, now keep in mind, saving about $780,000 of tax deferred, their total tax will be over $1,025,000 if tax rates don't go up. So their tax will be more than what they've saved in their accounts. Now, if you're older and you don't have as many years to have all these required minimum distributions in this deferred tax that creates more tax, then it's typically about a 1-to-1 ratio, right? So if you've saved $500,000 in retirement accounts and you're let's say X number of years into retirement, you're going to probably give up at least $500,000 or more of taxes. Let me give you an example. This is coming from Becky Swansberg with Stonewood. She says, over the past year, Congress has been busy debating new tax and spending packages. And boy, have they, folks. I mean, you think about the Secure Act 1.0, the Secure Act 2.0, but here's what she says that's a bottom line that I really think we all need to pay heed to, right? Congress has shifted from incentivizing Americans to save for the future to penalizing Americans who have successfully saved. I see this time and time again, folks. If you're somebody trying to work getting to retirement or better through retirement, here's where the rubber meets the road. You're transitioning, whether you like it or not, from an accumulation phase to a distribution phase, and the rules are different. And the exposure of risk is far greater when you go into this, kind of decumulate or, distribution phase, because you got to start spending this money down, which most cases on the money saved is all going to trigger taxes, and they're going to trigger taxes in a lot of different fashions. Taxes on income, federal, state level, Social Security, Medicare, capital gain tax. Listen to this. The tax provisions. Now, I'm going to give a couple of these to you because I don't want to wear you out because this is so key. In fact, I'm going to teach you solutions of how to save these taxes with proven solutions with a track record of measurable results at retirementprotected.com. That's retirementprotected.com, retirementprotected.com. But to put it in perspective, please go to retirementtaxcalculator.com. Within under 30 seconds, you can see the tax exposure that you're taking on, and that's probably the best the tax is going to be. I think it's going to be way worse, but let's bring solutions. So tax provisions. Let's look at some of the most recent tax proposals from Washington. I'm going to give you a couple of them real quickly. Congress has discussed a new required minimum distribution applicable at any age for certain savers. So you don't have to turn now 72, 73, 75, depending on your birth year. At any age, if you've done so well of deferring your taxes, Congress is telling you indirectly, we want your tax. Now listen to this other one. Must withdraw 50% of the excess above the cap from their accounts each year. That's not just an RMD, folks. That's just must withdraw 50% of the excess above new caps that are coming of what you can save tax deferred. This will convert those tax advantage funds into annually taxable funds, meaning if you did so well in a Roth IRA and you're over this cap threshold, even though it's supposed to come out tax-free, they're going to make you take it out. Then you can't put it back in, so you got to go put it somewhere where they get to tax it again. And it doesn't end there. Another proposal stipulates that once savers reach a certain dollar threshold in retirement funds, They'll be prohibited from saving any additional funds. Finally, Congress has discussed limiting, and this is the one that I really want to wake you up to, limiting the ability for certain savers to convert tax-deferred assets into Roth accounts. So in other words, they're going to taketh away. The government giveth, here's this wonderful Roth thing Senator Roth threw out in 1996 to 1997. Put this money away with after-tax dollars, let it grow tax-free, and you can take it out tax-free. Wrong. Congress woke up and said, you know what, we're really bad at math, and boy, are they. We need these tax dollars desperately. Folks, go to retirementtaxcalculator.com and learn the retirement tax risk road you're traveling. And then this coming Tuesday, imagine more financial success, elimination of taxation, removing yourself from the tax system. And I've said this all the time. Don't let your IRA be an IOU to the IRS. That's exactly what it's becoming. Go to retirementprotected.com. That's retirementprotected.com. And it's a complimentary log on and learn educational webinar where I'll teach you proven solutions before it's too late. And it's never technically too late, but the sooner you address it, the less tax you're going to have to pay. The longer you wait, especially as we wait for these tax rates to shoot up after the Tax Cut and Jobs Act, it's just going to get more expensive. And the bigger your account values you allow to grow, the more conversion tax you're going to have to pay. In fact, I'll leave you with this. One deduction we'll talk about this coming Tuesday allows you to reduce your taxes. The largest tax deduction that we're aware of in our tax team, which makes up over 360 professionals, arguably this is the best tax deduction in the entire tax code, and no one I've met really has ever heard of it or used it. And it's been around since the inception of the tax code going back to 1913. Retirementprotected.com, retirementprotected.com.